Well, greetings everyone, and welcome to the Argonaut monthly video covering October 2025. Now, as always, you can read about the performance of the two Argonaut funds in our monthly fact sheets available on the award-winning Argonaut website. Now, the month also saw the first anniversary of the launch of the Argonaut Flexible Fund, with the aim of the fund to deliver strong returns with low volatility. And we're delighted to have repaid the support we received from our investors at launch and the additional interest we continue to receive with the results delivered in the first 12 months. Now, as previously promised, we also recently published our deep dive on Danish offshore wind developer Ørsted, intended to explain our long-held short position for the Absolute Return Fund, and that's now available to registered users on the website as well. Now, this month, without further ado, we are going to focus on cockroaches. Warren Buffett famously said, "There is seldom one cockroach in the kitchen when you start looking around." Short seller Jim Chanos has regularly exposed his cockroach theory, the assumption that any negative news reveals only a small part of a much bigger problem. And cockroaches were back in the news in October. Last month, Jamie Dimon, the CEO of JP Morgan, on his company's Q3 conference call, and in response to the recent $10 billion corporate bankruptcies of subprime lender Tricolor and auto parts company First Brand, warned, "I probably shouldn't say this, but when you see one cockroach, there are probably more." Now, cockroaches are renowned, I'm told, for being able to survive over 30 days without food. But corporate cockroaches are somewhat different in that they have to be sustained by ongoing financial liquidity. So there are a number of issues with financial market liquidity at the moment. First, despite a quarter rate point interest cut in October, Fed Chairman Powell pushed back against market pricing of a December rate cut at the October FOMC. Second, the $2 trillion US fiscal deficit, which needs financing, as well as the rebuilding of the Treasury General Account, or the US government bank current account, from just a low of $300 billion, an unusual low in July. Essentially, the government was nearly out of cash and obviously needs to accelerate its debt issuance in order to rebuild that facility. Third, the reverse repo facility, which is, if you like, the money market excess liquidity on deposit overnight at the Federal Reserve, now almost being tapped out. So the last figure was, I think, $35 billion, but this had been a peak of $2.6 trillion in 2022. Fourth, commercial bank reserves. So this is excess liquidity that commercial banks have on deposit at the Federal Reserve, now at just 2.8 trillion, having been 4.1 trillion in 2022. Next, the SOFR, so that's the commercial overnight repo rate. So this is used by financial institutions to access liquidity in return for posting collateral, that is now trading at an unusual premium to the overnight banking lending rate, or the OBR, the rate at which banks lend to each other. And then the effective Fed funds rate, the rate at which banks borrow from the Fed, trading at a premium to the midpoint of the upper and lower bound of Fed funds rate. And then finally, we've seen some use of the Fed standing repo facility, which is, if you like, an emergency repo facility. So cutting through all of the technical money market stuff there, you've got essentially liquidity drying up across a number of short-term funding markets where interest rates are generally higher than what they should be. This is obviously something that the Federal Reserve doesn't want to continue, because ultimately the Federal Reserve needs to control short-term interest rates. So The problem is that the supply of money financing assets is now lagging the demand for money to finance assets, and that would normally lead to a sell-off in assets because funding becomes more difficult. Now, in response to this, the Federal Reserve has also said it would end its balance sheet runoff or quantitative tightening in December. And there have been concerns expressed that the Fed ending QT will fuel an irresponsible financial boom, not that we haven't already had one. And the Fed has said that it will be reinvesting maturing mortgage-backed securities called MBS into short-term treasury bills, which will maintain rather than continuing to shrink the size of the central bank balance sheet. However, the size of these amortizing mortgage-backed securities is really quite small, so they're being repaid very slowly and is currently averaging $15 to $25 billion a month. So the claim that this will cause an irresponsible financial boom seems pretty far-fetched given the small sums involved. And on the contrary, it seems to us that it's unlikely that solely reinvesting these modest MBS proceeds back into treasury bills will be enough to resolve short-term interest rate liquidity issues. So to our mind, this means that further stresses in funding markets seem likely. And we'd also note that these stresses often accelerate towards year end when banks like to dress up their balance sheets for end of year reporting. So at least until the Fed does enough in terms of intervening in these short-term interest rate markets, there could be a few difficult weeks ahead, but one suspects that this will end with the Fed coming in and providing that liquidity. But the choreography of these things is everything. And another famous Buffett quote is that only when the tide goes out, he's speaking about liquidity, only when the tide goes out do you see who's been swimming naked. So the point being that when liquidity dries up, often it can lead to weak asset pricing and more than one cockroach coming out of the kitchen. At the moment, I would say this is a neap rather than a full tide, but let's watch developments. October witnessed several idiosyncratic incidences of deteriorating credit quality. First Brands, Tricolor, which we've already talked about. Cantor Group had some problems originating some Californian mortgages, and a BlackRock fund saw a big default of an Indian telecom entrepreneur. Now, systematic delinquencies for autos, office mortgage, multifamily mortgage, and student loans are also elevated, and this is showing up in the asset-backed security data. We'd also observed that the low-end consumer or subprime market in the US is generally showing signs of weakness. And if we think about what causes these idiosyncratic frauds, we would observe that cases of fraudulent lending tend to increase in elongated periods of prosperity, which is perhaps why Europe or the UK doesn't have such a big problem. But during these periods of prosperity, lending standards tend to become complacent. It's too early to tell whether this will develop into a systematic crisis. However, we have been increasing the size of our idiosyncratic short positions in companies we think are most exposed to a deterioration in credit, and also importantly, inability to continue to access liquidity on historical favorable terms. So there's now increasing scrutiny on the private credit lending market, which competes with traditional bank lending in SME and high risk lending markets. Now, private credit is estimated to have assets now of approaching $3 trillion or 15% of US GDP, mostly sponsored by private equity groups. And this has drawn particular skepticism since one, it's a new product, it's untested in a credit downturn. It claims to have a superior skill over or experience commercial banks. It suffers from a lack of transparency and promises returns which seem too good to be true. So, what's not to like? In addition to these concerns, we observed that private credit has an asset liability mismatch in that although it still has equity funding locked up over long periods, it's still reliant on short-term borrowing markets for leverage. So if liquidity in these markets dries up, so will its ability to fund its assets. And it might also get equity redemptions on top of that. And as Jamie Dimon has previously said, private credit thrives on optimism and lack of transparency. This combination is perilous. So during the month, Argentinian President Milei, La Libertad Avanza party won the midterm Argentinian parliamentary elections, resulting in a significant rally in Argentine assets. Now, as with many emerging markets, the stock market in Argentina is not very deep. The liquid companies are basically oil producers and banks. Now, as many of you know, we took profits on our Argentinian positions earlier this year after OPEC began increasing its export quotas, making exposure to any oil producers elsewhere in the world less attractive. Despite the recent $20 billion currency swap line offered by the US, allowing the Argentinian central bank to support the peso, we believe that at $60 oil, rather than 80 where it was, the currency needs to float at a lower rate for the economy to regain its competitiveness. And it's not a good idea for the central bank to continue to waste its foreign currency defending the peso. So although we are happy with the outcome of the election, we're content to watch for now the restructuring of the economy from the sidelines. Bond King Bill Gross tweeted on October the 17th that gold has become a momentum meme asset. If you want to own it, wait a while. And lo and behold, soon after, gold fell 8%, silver fell 10% in a correction after a 32 and 48% appreciation since the beginning of August. But both gold and silver both were up during October as a whole. Now, we believe that the narrative for precious metals as a hedge against fiat currency debasement and the attractiveness of gold as money outside of the Western banking financial system for certain countries is as strong as ever. So we think it's still in a long-term bull market. However, given the outsized returns since August, it seems to us that the trade just got too popular, bringing more undesirable investment characteristics of increased volatility and higher correlation to risk assets. So we are therefore inclined to think that a period of consolidation is now necessary and have taken profits accordingly. Now this, along with the liquidity problems we've discussed in the short-term financing market, might be an ill portent for other momentum trades or trades that have done well. And we have been reducing our net equity exposure and have been looking for unglamorous longs that still fit our stock picking criteria. Now, October also witnessed so-called AI hyperscalers continuing to revise up their capital expenditure on data centers during Q3 reporting. The big five, Amazon, Microsoft, Alphabet, Meta plus Oracle, are now forecast to spend some $566 billion in 2026, up from 441 in 2025, with this 2025 number having been revised up 45% over the last 12 months. Now, those are big numbers compared to a 30 trillion economy. So from here, can AI capex and AI capex expectations really go to the moon? Now, whilst Meta disappointed the market in its ability to generate enough consumer revenue uplift from its AI investments and is at the same time increasing capex the most by over 50% next year, those companies exposed to corporate cloud demand, Microsoft, Alphabet, Amazon, and Oracle, were able to demonstrate a more pleasing pickup in revenue and backlog. But in our view, booming corporate demand doesn't really resolve the question about whether the hyperscalers are just prudently allocating capital, or just allocating capital to each other, with the tech bros getting high on their own supply. And it also comes on the back of a frenzy of round tripping deals whereby firms have been funding revenue growth through investments in their customers, which obviously is normally a red flag. Now, we also note that since it takes 2 to 3 years to build a new data center, reported shortages of compute today are often based off pre-boom capex for the big five of just 156 billion in 2023, rather than the 566 billion they're now forecast to spend in 2026. So lots of risks, and we think it's probably too early to short the AI trade, but almost certainly too late to be long. Now, our highest conviction trade remains in oil tankers, which remains reassuringly unglamorous, with the tightening of sanctions on the Russian dark fleet and the increase in OPEC export quotas has seen rates for the hire of very large crude carriers, or the LCCs, hit multi-year highs. Now, we believe this, as well as the end of refinery maintenance and low inventories, will also soon pull up day rates for clean product tankers, and we look forward to a festive period of abnormally high profits and dividends.